So I think the number of participants is roughly stabilized. What I will do is now start the webinar properly. We've got, as I said, three talks. The first talk is on inflation risk management, the second on sustainable insurance products, and the third on IORP risk management. So all topics that are highly relevant to at least certain parts of the AAE risk management community and to the actuarial profession more broadly. I'm going to leave the individual panelists and presenters to introduce themselves. I just want to say that they are all leading members of the AAE risk management community. So Jason chairs the group that's been looking at inflation risk. Frank Schiller is an AAE board member and previous vice chair of the risk management committee and previous chair of the sustainability and climate related risks working group within the AAE. And Martin and Carol are two members, a chair and a leading light in our IORP risk management working group. So all experts in their fields, and we should find out a great deal from them. So without further ado, I'd like to introduce Jason Weeb, who is going to talk about inflation risk management. And just so that we can ensure we get good participation, I think there's a Q&A facility. Do please post questions to that so that we can make this as interactive as possible. Thank you. Over to you, Jason.
Thank you, Malcolm. Just a bit of background. As Malcolm said, I've been leading this working group that has been looking at inflation risk management, and sort of as a bit of a genesis, this discussion about doing this started at our meeting in Rome in October 2022. Really started probably before that, as I was working on developing my company's Horsa, and my boards of directors were asking me a bit about what the outlook for inflation. And I realized myself didn't know as much about inflation as I thought I did. So when we were discussing this at the risk committee meeting, we realized that there was probably a lack of expertise given the past recent history. If you look, that's my working career. Now I've just highlighted on there, and inflation has just been this nice stable thing. But if you go back beforehand into the 70s, we had some pretty volatile times regarding inflation, which we just lack. I remember, but I don't have a really experience on that. Similarly, there's really, when we looked around there isn't a lot of risk literature on inflation in the actuarial sphere. Working group was formed. I put my hand up and was made chair. Martin, Richard, and Sam worked with me on developing the paper, and Malcolm got in the end did some great work on helping us edit the paper as we got different feedback going in. And really, our goal was to help actuaries understand the fundamentals of inflation and the associated risks. The paper I was a little bit ahead of myself. The paper has not quite been approved, but we expect it to be approved and published very soon. Paper's really got three main sections. Starts off with an introduction to inflation, making sure everyone understands the very basics. We get into a section about managing inflation risk, and then we talk about some of the risks that are available out there. So some of this is pretty basic there, but really there are three main causes of increased inflation. Demand is increased faster than supply, so prices go up. Supply is reduced, but demand hasn't, and so prices again go up. And the third one is maybe is a bit more unique, relating back to human behavior. people have fears about inflation coming. It may lead them to change their purchasing patterns and reduce their savings, increasing demand at that point in time. Now, if the perceptions about future inflation coming forward, that increasing demand and the supply isn't able to adjust, then again, prices will go up, and this could actually be a bit of a spiral, and that's sort of what did happen in the 70s in there. What causes inflation? Really, a lot of inflation can be tied back to expansionary fiscal policies. Governments looking to grow the economy are cutting taxes and or increasing investment into the economy. That can result into an increase in demand that perhaps, again, if the supply side of the equation doesn't react accordingly, would cause price inflation. The central banks try and use monetary policy to control inflation, and we've seen that over the past year or so. Basically, what happens there is they increase interest rates, trying to make the cost of borrowing more expensive, and as a result, reduce demand into the economy. There are so many types of inflation. We don't experience it often, but deflation does occur. It is when prices of goods and services occur. It often signals a downturn in an economy, and right now we're actually seeing that in China, where consumer demand and has actually caused prices to decline a bit. But also maybe signaling something positive. During the second industrial revolution, we saw a significant period of deflation as automation in industry saw prices to decline over or extended period of time. Hyperinflation is another special case, and this basically occurs when there's rapid and excessive and out of control price increases. Basically, governments are trying to have increased its money supply to a point that it can't support anymore, and prices just start going rapidly. We saw this in post-war Germany. We saw this in Zimbabwe in 2007 to 2009. There are other examples out there as well too. The other thing is referred to as stagflation, and this happened in the 70s during the energy crisis. And there you have the unique situation where inflation is growing rather rapidly, but at the same time, the economy is in a stagnant situation and not really growing. As I said, it is generally caused by an external shock out there, such as an energy crisis, or at this point, we've been lucky thus far to avoid this with the current crises. Just maybe want to draw attention to a few different points in time. As I said earlier, during the second industrial revolution, we saw deflation, and that period is often referred to as the Great Deflation. Great Depression saw deflation as well. The two world wars saw significant inflationary times as wartime spending was significant, and the period of 65 to 82 is often referred to as the Great Inflation. And if you read upon it, there's some good papers on the St. Louis Federal Reserve Bank. Just really happened there is there was a lack of understanding between expansionary fiscal policy and its link to inflation, and basically led to inflation expectations becoming embedded in the consumer, and so inflation grew rather rapidly. So what is the impact of inflation? Basically, it changes the value of savings, and if you're seeing high inflation, your savings of today have less value than otherwise, because they're going to purchase less in the future. It also reduces the value of assets that you own, and may be more advantageous to borrowers because reduces the burden of existing debt that you might have at that point, because there. But generally speaking, low amounts of inflation are seen as good. They encourage spending and future investment into the economy. So what are we facing right now, or how do we get to where we are? Pre-pandemic, we saw a lot of printing of money through quantitative easing, so the money supply grew. Further, when the pandemic came along, the money supply grew further as on different social relief programs were instituted. Consumers weren't able to spend on a lot of things, so led up to a lot of pent-up demand. And then when we came out of the pandemic, the supply chains weren't able to cope, either because the breakdowns in the supply chains because of the pandemic preventing goods being shipped, or just there wasn't enough produced in the time to do it. And then we got, on top of that, Russia invaded Ukraine, which compounded the situation, and the led to a shortage of a number of key commodities: oil, natural gas, grain, sunflower oil. And at the same point in time, there have been government support programs looking to provide support to those hit by this the increased inflation, which is further growing the money supply. The other thing to just talk a bit about is there are many different, there is no one thing of inflation. Inflation is relative to what you're looking at. Inflation will vary by sector, inflation will vary by country, by service, by product. When you hear in the news about inflation, what they're talking about is in headline inflation. It's usually expressed in terms of the change in the country's consumer price index, how a defined basket of goods and services have changed, and that generally includes food and energy. There's another term called core inflation, which measures the change in goods and services excluding food and energy, which tend to be much more volatile, and that gives a better sense of where it is. The other thing is this: wage inflation is different there, because companies may respond differently to inflating wages versus what the cost of living is. So in considering your risk, you need to understand the underlying costs. If you've got an insurance product with index benefits, these will be typically tied to an external index. If you're looking at the expenses of an insurance company, those tend to be more heavily weighted to wages and rents and rather than consumer goods. So the measure of CPI is maybe not a good measure for there. And if you're doing indemnity insurances, it often is very specific, sector specific. For example, medical services, automotive, veterinary services, those kinds of things. Turning to managing inflation risk, I'm a big believer you start managing the risk before you even start writing the product. You need to think about this in your product design right from the start. Looking at the product, see what the potential sources and impacts of inflation are, and see if there are things you can do to put into there. For example, if you're putting an indexing rider on a lifer product, perhaps you want to put in caps on the amount the index can go up, just to manage the risk more. Or maybe we want to maintain price, the ability to adjust prices. So again, some of the examples you need to be thinking about are, again, the indexing on fixed benefits. What is the true driver of inflation on that product? And one thing as well too, inflation will wear away the benefits of deductibles and caps as the costs go up more. So it's something you need to take into consideration when you're repricing those products and using historical experience. The other thing I think you need to think about is management actions. Plan ahead for something to go wrong. So what are some of the things you can do in the event of unexpected inflation? Can you cut your costs? Can you implement rate increases? Can you make changes in your investment strategy to take advantage of the inflationary times? The other thing is you should be developing key risk indicators in advance to help you identify that inflation may be about to creep up. Again, it's very important to have these risk indicators that are leading indicators, so you'll be able to react in advance and for potential inflationary pressures. It is possible to go out there and hedge inflation risk. There are index-linked bonds out there and inflation derivatives available to hedge these risks. The market for these derivatives are actually much smaller and less liquid than other typical derivatives markets. So that increases a bit of the basis risk, and you're more likely to have some basis risk in there. You may not have a country-specific or market-specific index to use for inflation, so you may end up using EU indices in the derivative. Your country-specific inflation may actually differ quite significantly from the EU, so you have a basis risk if your index is tied to country-specific. And again, if you're this is further compounded if you're in a country that's not pegged to the currency is not pegged to the euro, because you could have basis risk there as well. The other important thing to do is look at stress and scenario testing, and don't wait till the time you get to the ORSA. Consider it as part of the product design phase. If you're looking at the ORSA, is looking generally at the company as a whole, but again, trying to make sure your products are well designed beforehand to deal with the ORSA. Now, if some of the scenarios we were looking at when we wrote this paper, already being in a high inflation area, was what was likely to happen is were we able to see inflation return to target levels because the economies went into recession and the central banks didn't have to raise the rates as highly as they did. The central banks raised rates rather quickly to curb inflation and effectively, which seems to be happening right now. Central banks raise rates more slowly, but they're not able to get back to their historical targets because of a tendency not to want to hurt the economy too hard by raising rates. And finally, central banks may be unable to go into control the inflation, and may see a period going forward similar to what we saw in the 70s. And if you're looking at this for product design purposes during stable times before we get into a period, again, look back to history to see what inflation scenarios have occurred in the past. Some of the key inflation risks are there. If you look at directly insurance company, expected expenses will grow more rapidly than you might expect it in your pricing and in your business plans. Index benefits may grow more rapidly than you price for or expected in your business plan. For those products that are indemnity, where you're indemnifying people, the underlying costs may grow rapidly than you might expect. The inflation within your sector may actually be quite different from general inflation. And, as I said earlier, high inflation erodes the benefits of deductibles and the like. At more macroeconomic level, increasing interest rates increases the cost of borrowing, leading to less borrowing and potentially higher defaults. We're starting to see the high interest rates in some markets. They're starting to cause borrowing to slow down. You're dealing with securitizations, especially those that are highly leveraged or maybe at lower tranches may become more particularly volatile than they would have been prior. Owners of insurance policies may react. They may look to elapse the policy or reduce coverages. Increase in rates may lead them, those with cash value life insurance, to surrender the benefits for higher returns or potentially lower premiums, or because of affordability issues. Non-life covers may see non-essential covers not renewed, and benefit reductions made such as increasing the deductible to reduce costs that can be afforded. The other thing to think about, is potential for bank runs. If people are concerned about the financial sector or particular banks, it could lead to mass withdrawals. We did see this earlier this year with Silicon Valley Bank and Signature Bank in the U.S. Some asset managers may see losses. Those that are highly leveraging funds may find increased interest rates difficult to carry. And finally, emerging markets may find it very difficult to pay for the higher interest rates on their debt and may be forced to default. think that's about it. I don't know if Malcolm, if any questions have come in, or if anyone has any questions at this point.
Thank you very much, Jason. That was a fascinating talk. I can't see any specific questions that have come in from participants, but if Carolyn can and hasn't, I haven't seen them, then there aren't any in the Q&A itself. There is one which says, "Will we get the slides after, please?" And I think that is something that is typically organised by the events team. So I think the answer to that is yes. Whilst people are thinking of other questions, we've got another question, which maybe if I summarise is what is there any particular pattern of how inflation impacts insurers, and maybe that's differently to other typical participants? So if you were, someone from Mars and you'd arrived in the financial sector, you'd heard of one or two things. Presumably, it's what makes insurers distinctive in this space, but or maybe life insurers versus general insurers versus reinsurers.
Yeah, no, that's a great question. I think the answer really is it is company specific. I work for a large life reinsurer, and the nature of our risk profile, the benefits of the increased interest rates greatly outweigh the additional costs that we might see on at this point in time, because we don't have a lot of it's life insurance. We don't have a lot of indexed riders attached to our portfolio, so it's actually quite positive for us. The expense impacts are outweighed by the gains on the investment portfolio that for reinvestment and the like. I think general insurers, again, depending what their lines of business are, could be seeing it and will be hit differently at this point in time, whether it's medical inflation or pet insurance or automotive insurance. They'll all be different at that point in time. So I think it really is company specific. You really have to think about what drives it for your company.
You right. We've got another question. Is there anything that we should be monitoring, say, quarterly, to see whether inflation is kind of quotes as expected? And also, how do you work out what quotes as expected might mean in this context?
I dreaded this question out there. I haven't for everything. I haven't implemented anything out there. I think what I've been doing personally is monitoring. Actually, I think one of the best things is just to monitor the news and what is being said by the economists and by your investment people about what's happening out there. I think I did see the conference boards out there do have some leading economic indicators out there, and again, I think it's just a matter of monitoring what is being said about the sector at this point in time. Probably in more specialty sectors, I guess you can probably look back and do a time series. This is something I did for credit risk. There's time series analysis to see if there is any sort of leading indicator that might foretell a sudden increase in cost coming along there at that point.
Okay. Fernando has asked a question, which is, when you're talking about managing inflation risk, do you mean quote short term or quotes really short term? So I guess the way that I would paraphrase the question, if that's the right way, is what kind of time scale is it worth thinking about when it comes to risk management? Maybe that also depends on the product type that you're writing, though.
I don't think it is not really a short-term risk. If you look in there right now, we've seen a situation whereby, I don't know, what are we now, about 12 to 18 months into a period, I guess 18 months into a period of high inflation. It has been coming down, but to be honest with you, is it going to get back to the 2% targets of the central bank? Nobody knows. I think there's a lot of people concerned that it won't. Then again, if you look back at the history, it is in the 70s there, we did see a period of significant inflation for a long period of time. So I do think you need to recognize the fact that this could be a long-term phenomenon, and that that could change the way you do business for that period of time.
And I suppose if, in certain circumstances with hyperinflation, the price doubles every sort of day or two, then it becomes very important to focus on the very short term, but you have other more significant stresses. We've got maybe time for one more question. Maybe I can just chip in here. On slide 12, you talked about stagflation being due to a kind of lack of understanding. Do you think we actually understand inflation better now? Or do you think it was just kind of like we failed to take the medicine, as it were, in the past, and maybe there's a risk we will fail to take the medicine now?
The world, first of all, I was going to say the world is an ever-changing place. So to say we ever understand it is probably anything is a bit of an overstatement. I read a couple of different papers on the 70s, and what was happening there is governments were trying to grow, didn't understand that the link between expanding the money supply and inflation in there, and they kept trying to grow the economy, and inflation got embedded in there. And so there's some great papers written on this in there. Again, St. Louis Federal Reserve Bank had published a few of those in there. I think we have a better understanding. Central banks have a better understanding, but again, the question maybe is, what are the second order impacts in there? Of hammering the economy with for a long extended period of time to drive down inflation. So
okay, so maybe we need to be careful not to assume that we are cleverer than people in the past. Thank you very much indeed.
Yes.
That was a very interesting presentation. Maybe we should now move on to the next presentation, which is from Frank Schiller. He's going to talk about sustainable insurance products. And maybe over to you, Frank. I think, Jason, you might need to unshare your screen, and then Frank will be able to share his.
So here we go. Should everybody see my screen? Is it working? Excellent. Well, thanks Malcolm for the introduction and for giving me the opportunity to speak about the work of the AAE Sustainability and Climate Related Risks Working Group from last year and this year. We have discussed together in a subgroup of people, what does it mean to have sustainable products or insurance products? And I would very briefly guide you through these ideas we have. For more details, I would also like to relate you to the paper we have written. Climate change is actually one of the topics that is currently driving us all in risk management. So everything when you think of these different waves that came, COVID-19 was coming in different waves, but then it was not just COVID-19. We just heard about inflation from Jason. Climate change is already here, and it seems to stay and seems to become more and more severe. And this might not be the end. So we also have to think of topics like migration of peoples and loss of biodiversity. And all of these different risks are connected. And the idea why we think we have to consider all these different risks, and climate change is a very relevant of all these risks, is how could we tackle that? And it's not just about climate change, it's about a more general concept of sustainability and sustainable solutions in insurance. And what I mean with that is, when I might quote the Brundtland Commission, what they say is that sustainability means meeting our own needs without compromising the ability of future generations to meet their own needs. And when you think of that, it really tackles all three aspects. The environment, that's what we typically think of when we think of sustainability. It's climate change, it's biodiversity. It also gives our boundaries. So we have just one planet. We cannot grow beyond this one planet unless we want to populate Mars, for instance. But then within this environment, we also have to think of society. Society, we need our basic needs. We need education, equality, well-being is part of what we need to survive as humankind. But we cannot do it without our environment. And society is actually also what limits, again, the growth of the economy. So economy in that sense is just part of the other two. Environment is perhaps the bigger frame, society is within that, and the economy is kind of limited by all the other. And when we think of, well, unlimited growth, it's rather obvious that we cannot think of these growth aspects in this limited world. On the other hand, we started thinking of climate change as, well, tackling carbon footprints, for instance. But it's much more. It's not just about natural resources. When we think of sustainability, it's really also about considering social and economic resources and aspects. And that's what I want to discuss today. And in that sense, also the topic on inflation might even be part of this sustainability aspects we consider today and we discuss today. And it's not just about risk management. Typically, at least in Europe, when we think of sustainability, we always speak of this concept of double materiality. So it's one hand side, it's the risk management aspect. So the left hand side in this graph, it's the outside in effect. It's the effect climate change and other aspects like economic changes might have on a company. There, the primary audience is the investors, or are the investors, but it's also the regulator who is interested in that. But then we also have to take care of the inside out effect. What kind of effect do we as insurance companies have on the environment, on the society? And for that, we have a much broader audience. It's the clients, it's the employees, it's the society, it's also investors, obviously. But we also have a feedback loop there. We have to think of reputation and litigation risks that kind of feed back into the outside-in risk. So it's always that we have to consider reputational risks as well when we think of climate change and sustainability. Interestingly, when we discuss that, when we look into European legislation, yet life insurance is not really included in the taxonomy for the environmental objectives for some reasons. It's again about focusing, I would say. And more interestingly, when you look into the more international aspects, what has been done by the IFRS Foundation, they not even explicitly included double materiality considerations as we do it within Europe. So again, something we have to consider, and where we in Europe perhaps have a more advanced view on that topic. What I want to introduce today, after these first 2 slides, is this paper I mentioned before on sustainable products in insurance. And I want to really briefly touch on those 5 chapters of this book. Oh, sorry, not the book, of the paper. It's first sustainable savings products, then more general aspects of sustainable insurance products, not just savings products, but much broader, and how to establish insurers as a long-term partner. Then what does it mean to look into the sustainability development goals, and economy and society as additional aspects, and then how this again links to reporting and taxonomies, and then a brief conclusion. So let's first start with savings products. What we currently have is we have an existing standard. There is an EU taxonomy for companies, investors. It's actually relevant for both banks and insurers. So all products, all savings products are kind of within this EU taxonomy, and it's a consistent view on these type of products. They are classified into 3 types of products. It's called Article 6, 8, or 9. And well, obviously, it's not very transparent. And perhaps that's also one of the biggest topics where many countries in Europe currently struggle. Our sales forces in insurance, in banks, they have to translate that and have to inform consumers what does it mean to buy an Article 6, 8, or 9 product. What aspects are there considered, and what might be the right product for a single person. It's a very relevant part also for the consultation during buying fund products, for instance. In many countries, what I've heard in Europe is that our sales forces struggle with that, and actually the public is not yet as well informed as they might need to be to really understand what's behind all that. Main reason for that is really a rather high level of uncertainty and confusion about the suppliers, as the regulation and the reporting requirements are at some stage rather vague or not easy to interpret. And we just even had recently some products reclassified from Article 9 to 8, as they have been kind of, well, judged differently in the past, and now it has been seen more strictly. This gives this risk of, well, again, perhaps this problem of greenwashing, the problem of reputational risk, or even litigation risks that might be included in providing such products, and kind of promote them as Article 9, but then eventually they might be reclassified into a lower grade, into Article 8. So what is it all about, these different articles? Article 6 is what we would call non-ESG or non-green products that do not specifically fulfill ESG criteria. It's what you might call mainstream products. Then we have light green products, Article 8 type of products. These products, to quote there, is they promote environmental or social characteristics, or a combination of both. So already these products are not just focusing on the environmental aspects, they also focus on social aspects. So ESG is really seen as a broader aspect of sustainability. And they have an explicit ESG commitment as part of their investment objective and process description. And then we have these Article 9 products, which are called, well, perhaps dark green or really sustainable, and they should have a sustainable investment objective. So they have measurable goals, how they can really have an impact. So it's a bit what you might also call an impact investment, or you want really to have an impact with your investments, and that has to be made very explicit and measurable in these funds, in these products. And again, you can see that fulfilling these rather strict criteria in an Article 9 product is rather difficult, as it needs to be very clearly measurable. And that was one of the reasons why it has been reclassified. And one of the problems really was that data wasn't available to really prove this measurability. So it was a lack of data, not even a lack of the product design, but it was a lack of data for many of these products that led to a reclassification from 9 to 8. When we look a bit broader, not just into savings products, but into general products or insurance products, what does it mean to have sustainable products? And EIOPA did a first step into that. They discussed in one of their papers what they call impact underwriting. So it's not impact investment. That was the last topic on sustainable savings products. It's really now on the liability side, impact underwriting. And there it's quite clear, impact underwriting really means that first, the focus is currently mostly on climate change. So it doesn't look into social aspects yet. And it really is also a combination of not that the investor or the buyer of such a product has to make this impact, but also the in that case, the insured or the seller of the product also has to provide a certain means of adapting. And that's also part of the general concept of sustainable solutions. We come to it later. It's always a combined effort of all parties involved that it needs to be sustainable by combining the efforts. So for instance, including impact underwriting would mean that these products might include adaptation measures. You might want to include alert and warning systems. You want to include risk prevention measures. So it's more than just an insurance product itself as we know it, but it might even include additional services. So that's what already EIOPA thinks of general insurance type of products, where insurance companies are more seen as a long-term partner and really solve some of the problems, even not just transfer risks, but then even prevent some of the risks as an additional service. Even further is what PSI, Principle of Sustainable Insurance, thinks of. It's something founded by the United Nations. When they think of insurance or insurers as long-term partners, it's really going even further. First, it's important that ESG criteria are really embedded in all decisions in these companies. So be it risk management and underwriting, be it product and service development, be it claims management, and be it sales and marketing. So it's even getting further than just the impact underwriting, what we've seen from EIOPA. Then it's really seen as a joint effort. So insurance companies for themselves cannot really reach these goals. That to provide, what we want to do is we need to provide solutions that are really on a long-term basis solving the problems we have in society, environmental aspects we have to consider. So therefore, we need to raise awareness for all our clients and business partners that we can kind of join forces and work together to manage these risks jointly and develop solutions jointly. Then it's not just this joint effort together with clients and business partners, it's also together with governments, regulators, and other key stakeholders to really also promote actions on these ESG criteria. Some of the topics could even be public-private partnerships to really solve some of the topics where just insurance as a sector for itself cannot solve it alone, but we would need the government and regulators to support us to really join forces and solve these big topics. And then last but not least, and therefore we have this topic also in our paper, we need to demonstrate accountability and we have to be transparent in what we are doing. And therefore we need the reporting and we need to disclose publicly what we have achieved so far and what are our targets and how far are we on our way towards these targets. One example to make it a bit more tangible, and perhaps also to explain why it's a bit more than just impact underwriting, what we've seen from EIOPA. What could be such a sustainable building insurance product? It has to really tackle several topics, and it's just 4 examples that might be part of these products. It could even be including much more topics or much more features. But first, it needs to be still attractive and attainable for house owners, and that's the sustainable societal aspect. You want to avoid protection gaps so that people are still able to buy such products. So therefore, people should be able to afford it, and it should be attractive for really house owners to buy such a product, to really protect themselves against these environmental effects and hazards. Secondly, there need to be a certain element to determine extreme flood risks to the building. So to identify these risks, to measure these risks, and also to be able to think of measures against these risks. Then it's very important that not just the product itself provides these services and this transparency, but then also sales advisors and underwriters inform and discuss these aspects openly and transparently with the policyholders, that they also are aware of certain mitigants to avoid these risks, to mitigate these risks, and also to find countermeasures against these risks, and to manage the price of such a product. And last but not least, it's not just about the underwriting itself, it's also about claims management. For instance, in the US, it's already quite common that claims payments are not just always paid out independently of what happens with the money, but they are linked to a certain requirement to rebuild the house, either in a less exposed area or to include additional measures when rebuilding the house to really avoid or reduce the risk for the future. So as you see, it's really a broader, a more comprehensive approach to design such a product, not just with a focus on the underwriting itself, but really also including aspects of sales, claims management, and perhaps even other means like being a transparent use, like the government to provide transparency and certain incentives for managing these risks. When we have to go a step further, the question really is, how can we measure, how can we kind of design such a product and really see what kind of effect do we have inside out? What kind of effects do such products have on the society, on the environment when we produce such a product? And typically, all of you know the Sustainability Development Goals. You see them on the right-hand side. Here, I've structured them on 3 levels. So the planetary boundaries, society, economy. Planetary boundaries is the environment, as we called it at the very beginning. And what you need to do is really consider all these different aspects and think of what kind of objectives does such a product have. Would it be harmful or beneficial for these objectives, for these sustainable development goals? And then for each of these objectives, it's relevant to assign measures and describe risks and opportunities of how we could have an effect on these objectives. And last but not least, we need to make sure that we can really measure these achievements and be transparent and really can also report on our achievements. And this is very relevant for actually all 3 parties, for investors, customers, and regulators, because they will measure that and also want to see transparency, and they will also judge our products, and judge us as companies if we are a good company, a green company, and provide these solutions to society. It's really important that these products really provide a consistent, or are embedded in a consistent reporting framework. The problem really is that especially larger insurers might develop, and that's what we currently see, they might develop frameworks independently, and they're not really consistent. So like insurance companies operating worldwide, they might have different views on certain topics, and especially for consumers and investors, it's still difficult to translate these different frameworks. In the end, it is important, and that's also one of the tasks for the regulators, and also for a consistent taxonomy, be it the European or the IFRS-based taxonomy, that we provide consistency on these overviews. And I think, on the other hand, we should avoid an overburdening additional effort on reporting, which is really time consuming. So we have to find kind of a sweet spot, being transparent, but also effective and efficient with these reports we provide there, that it's really also readable for the investors and for the consumers, and it's understandable. So what examples are there where we could help to understand our stakeholders, what kind of products do we provide, and how could we affect the environment, the society, and the governmental or governance aspects. So there might be certain value-added services, as I mentioned before, reporting services, providing measures, risk alerts that prevent the insured perils from occurring, so that we can really mitigate these risks by informing our insured population, our portfolio. Then it could be relevant to provide, well, instead of paying out money, we could really provide possibilities to restore certain assets, to use circular economic principles, to kind of recycle, instead of just repairing and wasting the destroyed goods. Then, especially for social aspects, it's very relevant to also think of not just paying out, like certain annuities when somebody is impaired, for instance, but then also think of services, how we could restore the customer's well-being, how to bring them back into a normal life, and really bring them back, and enable them again to work, for instance. And last but not least, and that's rather looking into topic underwriting, there might be additional or new technologies and innovations that might improve the accessibility or affordability of certain products, again for providing social aspects of sustainability, to broaden the access to certain groups of the population who currently don't have the access to such covers. So all these aspects are relevant, and there are even more, and we can think of all these aspects to improve our products and advance sustainability or sustainable solutions for the products that already exist. Last but not least, as I said before, it's important that we are transparent and that we can kind of report how we have improved and how we will also in the future still improve our solutions, and how they will improve ESG aspects for the whole market, for the society. And when we look at the current European legislation, the main aspect is currently on the non-life and the investments. And for both, there are green ratios we have to report in the future, or currently already have to report depending on the company size. It's either for non-life, it's a green premium ratio, how many products are seen as green compared to the whole portfolio, and the same is true for investments. So how many of these products are classified as green compared to the whole portfolio? That should give a simple figure, a simple ratio to classify both the liability side and the asset side. But still, you can imagine it's difficult, because what does it mean to be green? We had this discussion before. It's very time consuming to set up such a reporting requirement within a portfolio of an insurance company. And again, it needs to be consistent and comparable between different companies. So that's really something we have to think of. On an international basis, IFRS is also working on a unified framework for such a reporting of climate and sustainability risk. As I said before, it's not yet including this double materiality aspect. It's rather focusing on the risks aspects and opportunities, but not really what the impact of a company is on society. There currently are three main blocks. I named them below. The main challenge, and that's what we currently are working for, and therefore it's also where actuaries are needed, is all these requirements are currently rather dynamic, difficult to interpret. Interpretation changes over time as things become clearer, and they're very complex. So it's really difficult to tackle. And one of the examples I just mentioned before, what led to this reclassification of Article 9 to Article 8 products, is a lack of data, and that for some of these aspects of this classification and also of reporting, we still need expert judgment. It makes it difficult really to measure exactly these effects, and again, we run into transparency problems and issues. All in all, we are just in the middle of all these reporting requirements and sustainability topics. And on the other hand, it's important that we take this opportunity to already now start producing such sustainable products. We cannot wait till we have clarity for all aspects. Even so, regulatory and reporting requirements are changing rapidly still. So we have to be very careful when we want to create such products, because we still have this wide scope of interpretation, and it's not a solution to just wait and till everything's settled down, which might take another 5, 6, 7 years. Then it might be too late, and we might have lost the speed, and really others might have produced these products and might be first movers, and we might lag behind. So therefore, again, it's us actuaries who could support our companies to find the right way forward, the sweet spot of what can we do already, where can we already provide certain aspects and translate that into sustainable features of products without risking this problem of greenwashing. And in the end, perhaps it's just one sentence what we can have as a conclusion. And again, now I'm starting with the economy over society, and then the final effect on the environment. What we need to do is we need to offer insurance and related services at a fair and affordable price for securing a world worth living in. And I think that's a very good kind of vision for us as actuaries for what it's really worth working, and where we can really have an impact. So thanks for listening.
Thank you very much, Frank, for a very stimulating and interesting talk. So as before, maybe if you can post questions in the Q&A, then we can take a few of them. We've got a few minutes. where we can run through some questions with Frank. There's one already in the Q&A, which is from an anonymous participant, who highlights that you've already indicated there are several different firms coming up with different frameworks and different ways of doing things. So the participant asked, shouldn't they therefore return to some kind of standardized approach? And the person highlights the Net Zero Insurance Alliance, particularly now that the NZIA has dropped stringent requirements, some of the stringent requirements that they had. So why are they not going down that route?
Yes, it's a very good question. It's a very tricky question, and especially the Net Zero Insurance Alliance just showcases the conflicts we have. So when we want to go down the route and covering all aspects, environmental, social, and governance aspects, sometimes they might be conflicting. And exactly this case, and I just can speak of some of the bigger companies. I'm working for one of these companies. We had to consider the environmental aspect versus the governance aspects as a company, and being part of this Net Zero Insurance Alliance would have meant that we might come into issues with antitrust. So that's what we saw in several markets, or at least in one very big market, the United States. And so in the end, it was a management decision to say, okay, what can we do now? Should we rather risk a governance issue, or should we really follow and focus only on the environmental aspects? And I think these problems we always have. And that's one of the problems we cannot solve by just providing a framework, because frameworks cannot decide for the board of management. In the end, it's the board of management of each of the companies to decide which priorities they want to take. Is it the E, is it the S, or is it the G? If there are conflicts between these three perspectives, you might say, or three dimensions, and you cannot find a consistent framework which can be followed by every company, because otherwise, it's really, in the end, it's the board of management to decide that. So yes, it would be nice, but I would say it's impossible. Yeah.
Interesting. So do please put some more questions into the Q&A. I think we've got a few more minutes. So maybe if I can pose a question myself. We've seen, well, at least I'm based in the UK, and we've seen a little bit of political pressure to slow down some of the climate change commitments on the grounds that the transitional costs for certain people, certain sections of society, might be unpalatable, at least for those sections of society. So this is a kind of like a social fairness issue. Is there anything that we as insurers can do that can kind of help or mitigate or handle some of those kind of emerging tensions that relate to different parts of society, rather than maybe just the kind of the economy or society as a whole?
Sometimes there's this tendency that insurers are seen as well, stepping into the gaps of social security, and that, well, we cannot do that to all, in every aspect. I think again, it's really the problem that there's a certain conflict between social aspects and then economical effects or aspects. In the end, we cannot subsidize without limits certain groups of persons who need money. So that's rather, and it's difficult to say, but it's true. It's rather actually the task for governments to find solutions for that. It's not insurance companies with their limited access or possibilities. So governments typically have broader capabilities, and if they cannot support that, perhaps we can join forces in a certain private-public partnership and consult and support them in finding solutions. But it's not. It's rather with knowledge where we can help, but not with money, I would say.
Okay. So Gianpaolo has asked that this the awareness of people in society is really essential in all of this debate. What's your opinion about that, and how might the insurance sector actually help expand that awareness?
Yeah, I can only agree with what Gianpaolo says. I think it's really one of the biggest problems we have to solve now, that in the end we cannot only convince people by providing incentives to lead a life which is more sustainable. It cannot be only driven by money that they decide to live a more sustainable life. In the end, it's a behavioral change we have to introduce in society. And I think that it's well, we could be one of the players to introduce these aspects when speaking with people, when selling products, and especially when it comes to natural catastrophes, and when it comes to really covering such risks like flood risks or hurricanes or tornadoes. It's insurance companies who have the expertise. So it could be us to really explain and also support the discussion of how to mitigate such risks, not just to insure them, but really in the end, we need to mitigate these risks. We have to understand and reduce these risks to become more resilient as society. The whole society needs to be more resilient. And for that, again, we can support and we can consult, we can provide knowledge. And that is something really in the sense of what also this group of principles of sustainable insurance, what they meant. It will be a joint effort, and insurance companies will have a big part in it, how to solve these environmental topics, because we can really measure these risks and we can support mitigating these risks to become more resilient as a society.
Okay, I think we've got time for just one more question. So Sam says, excellent talk. It's nice to know. He's wondering whether, as a society, we're actually making progress towards not just optimizing what we do, or getting the decision makers to optimize what we do kind of in one dimension or single item optimization, but how do we get policymakers to kind of think about things in a more broader, more complicated, more richer way of doing optimization? Maybe this is a kind of looking at it less from an insurance perspective, more from an actuary perspective, because optimization is the kind of thing that we have studied when we were actuaries. But is there anything that we can do, maybe from the actuarial profession, that can actually help decision makers, including boards of insurers and regulators and the like, grapple and actually get to grips with the richer optimization that is actually required to kind of navigate these issues?
Yeah, I think it's a very good question. I think that's one of the big issues we currently have in our society, I would say, and why people are currently sometimes even annoyed. I would even say that the world seems to be so complex compared to like 30 years ago or 20 years ago. And that's also because we have seen all these risks. So like COVID-19, like the inflation, like the war we currently still have in Europe, like climate change, and things don't go away. So it's really, they seem to stay. We now have to manage all these different aspects. And this is something, yes, well, the only thing what we can do is provide transparency and provide a certain quantification by models. And well, who knows me knows that I'm always saying all models are wrong, but some are useful. In the end, we could judge as actuaries, we could help find the right model to support the decision makers. Because it's right what you're saying. It's not just well, getting the best Solvency II ratio and that's it. So that's not, perhaps in the old days that was quite easy. If you have sufficient reserves, you were kind of, everything was fine. Now it's more complex, and we need to provide these tools and provide transparency and explain it to the decision makers how they can use these tools. We can provide them with all their deficiencies and problems. So, because as I said, so all these models are wrong, and we also need to make sure that those models and those tools are kind of applied in an appropriate way, and that's what we can do as actuaries. So I hope it
Make
would
progress
even,
on that.
it would even support our position in companies and in society. And then, by the way, this cannot be done by artificial intelligence. So that's really people. It's really actuaries, humans, who need to do that to see this complexity and adapt over time.
Brilliant. Well, thank you very much for that answer, and indeed all the others, and for an excellent presentation. I think we now should move on to the final presentation, which is from Martin Melchior and Carol Goosens, and they are going to talk about IORP, pension fund risk management, from a kind of European dimension, and also look at ORA versus ORSA. So maybe over to you, Martin. I think you're up first.
Thank you. Hope you can hear me. Thank you very much, Malcolm. So I'm the chair of the Pension Risk Management Committee, Pension Risk Management Working Group, which is a working group under the Risk Management Committee and the Pensions Committee. I'll go through some of the work we've done in this working group so far. I'll do half of the presentation with the introduction and the ORA versus ORSA work we've been doing, and then Carol will take over and tell you about the IORP survey we did. Hopefully what we will achieve with this presentation here is give you a different view on policyholder protection, and give you something to think about when you get back onto your companies. Before we start off, we'll just start off with a short poll here, because maybe some of you know about the IORP regulation, and maybe some of you know more about Solvency II. So I would just like to figure out what the audience here knows most about. So if you can just answer the question you have here, and then it'll be interesting to see. I'll just give you 30 seconds here to answer. Okay, Karen, can you see if we are starting to get some results in? Yeah, so we have only around 20% knowing about the IOP regulation, and most of you, as expected, are working more in Solvency II, and we have also someone who knows about both things. So thank you for that. As roughly half of you, know not much about the IOP regulation. Just a quick background here on the work we're doing in the Pension Risk Management Working Group. What we want to do with that is support the AAE in being more visible in the political environment on the actuaries' participation in risk management and what we can do in that area, and with the IOPS as a first priority, being that it's not a risk-based regime as we know from Solvency II. We want to learn more about that and how it affects the whole risk management part from IOPS. For those of you who don't really know what IOPS are, in broad terms, you could say it's typically pension companies where a company, instead of choosing an insurance provider for the pension plans for their employees, they'll make their own company for their own employees and the pension plans for them, and that is then an IOP. So that's like the broad definition of the IOPS. Before we move on, just a few words on what is difficult with the IOP market. Here is that we can see that the top graph is not, because we'll deep dive into these numbers here, but this one on top here shows that we have some IOPS where there's really big reserves, more than 1,000 million euro. But then we also have a lot of IOPS where there's really not a lot of technical provisions. There might be only 2 or 3 employees in the IOP, and then how do you make regulation that will be suited for both those companies where you have only 2 employees and maybe less than 100 policyholders. So that's kind of difficult here, where in the insurance market you typically see larger insurance companies in general. There's also both a lot of defined benefits schemes, and there's starting to be more defined contribution schemes, and you have companies with both defined benefit and defined contribution schemes. The graph here below shows the different countries in the EU, where the red bar shows if the technical provisions are in IOP companies, and the blue bars show where it is in insurance companies, so under the Solvency II regulation. So you can see here also it's kind of very different from country to country. If it's mostly Solvency II based companies or IOP based companies, where the Netherlands stands out really as the country with the most IOPS. So this also makes it difficult, and what we think, as we say here, it makes us wonder why is there such a big difference? Is it because of different national tax reasons, or what is it? And in the end, all the policyholders, they need a pension plan, but will you get a better pension plan from an IOP or from an insurance company, or will it be kind of the same? So that is some of the questions we're trying to answer in this working group. So what we've been starting out by looking at is comparing some of the 2 key products in the Solvency II regulation versus the IOP regulation. is the own risk assessment from the IOP regulation versus the own risk and solvency assessment from Solvency II. So why do this comparison? What we want to figure out here is we're seeking some answers. As I said, it's interesting if we should expect different levels of protection from and risk management from IOP 2 versus Solvency II, and if we should expect different levels of protection, is that fair? And can we conclude that one is better than the other? And probably most important for us, can we learn from each other? Other things here we can learn from Solvency II in the IOP world and vice versa. So before we start looking at comparing the ORA and the ORSA, it might be worthwhile looking at what is the purpose of the IOP regime versus the solvency regime, because if they don't have the same purposes, then it might not be fair to compare the ORA and the ORSA. In broad terms, they are both regimes that obviously have a general purpose of ensuring good pension plans and insurance for the policyholders. So in that sense, it is the same general purpose. I put a small icon for the IOP 2 purpose with the members there, some people there, because the IOP purpose is more focused on the members in its written purpose, and these purposes are directly from the IOPA webpage, so you can find them there. Whereas I used an umbrella icon for the Solvency II purpose, as the purpose of the Solvency II is more protection for a rainy day, making sure that the policyholders are protected by ensuring that you have enough capital set aside and making sure you're well protected going in that direction. So even though it's mainly the same purpose, we have that distinguished difference with the IOP 2 purpose being more focused on the members and the policyholders. It's directly stated that you need to invest in the best interest of the members and the beneficiaries. You have that as well in the Solvency II with the prudent person principle, but here it's stated as one of the main purposes. And also what is interesting in the IOP 2 purpose, you also have the communication part to the members. So that is simply part of the main purpose. I won't go too much into the first one here, which is that is need to support cross-border collaboration, which is because IOP 2 also should help those big companies that are working across border in the EU. But yeah, and as I say here, with small caps down here, it might not be completely fair comparison because IOP is a bit broader than Solvency II. Solvency II obviously is mostly focused on the capital requirement, and where you also have for instance, the insurance distribution directive and so on for the insurance companies. So you have some other legislation over there, which is more captured in the IOP 2. Yeah. So from this starting point and understanding the main purposes, if we look at comparing the ORA and the ORSA, then we can start to look at the similarities between the own risk assessment and the own risk and solvency assessment from Solvency II. It's both board responsibilities, so that's the same, obviously, as it is in the words. It's an assessment of risk, and it should be part of the business strategy and the management system. So in broad terms, it's you need to do the same, have a risk management and risk assessment process in place, whether you're an insurance company or an IOP. But then when we look at the more specifics for the ORA versus the ORSA, we see again the purposes from the two regimes being reflected also here in the ORA, where in the ORA for the IOPS, you need to do an assessment of the risks related to the policyholder benefits, and also an assessment of the mechanics protecting the retirement benefits. So here you, as an actuary or risk manager, you need to spend some time on considering what the risks are related to the benefits. And that is something that is that you don't see in the ORSA at all, as it is more focused on an assessment of the SCR. So you don't have that policyholder view in the ORSA. On the other hand, when you look at the ORA, then it's not a risk-based solvency regime. It's kind of the same as the old Solvency I regime, where it's roughly speaking, in broad terms, 4% of the technical provisions. So whether or not you have a risky investment strategy or non-risky investment strategy, or big amounts of longevity risk or whatever, it's your solvency capital requirement will be the same. So it's again two different views on risk, and that is something that we find quite interesting, and trying to figure out what should we learn from that. And in particular, could one learn from the other, and both ways. ESG is mentioned in both the ORSA and the ORA. ESG came in with the Solvency II review, and the ORA is only meant to be made every third year, which is because, as I said, there are many very small IOPs. So they won't have the resources to do it. So documentation and reporting is smaller for the IOP world. So in conclusion, I'll probably don't have too many conclusions, because actually for now we might have more questions than conclusions. But when we look at the risk assessments in the IOP world, we have this prudent regime, and when you are prudent, then you might not need to do as many risk assessments as if you have a best estimate regime. It makes sense, but maybe you could learn from the Solvency II world, and figure out how to do more risk assessments, even though your solvency capital requirement is fixed. Also, in the IO2 world, we don't have as many clear regulatory requirements on how to calculate the technical provisions and do stress tests and so on. So that is something that is more up to the individual IOP or the actuary or the risk manager. And then also again, there's a much bigger focus on the risks related to the benefits and the protection mechanics, and that is something that is not seen as much in the Solvency II risk assessments. It might be covered in the Insurance Distribution Directive and the rules about the product oversight and governance there, but maybe where the actuary and risk manager participation there is not as clear as in when you look at the Solvency II assessment. So for now, we just have some more questions that we in the working group will work on and pursue, and see if we can find some answers to, maybe. And as I say here, should the IOP regulation, could they use more guidance on risk assessments, even though also on for instance, assessing if the capital requirement is suitable or not, even though it's fixed. And for Solvency II, should there be more focus on the perspectives from the beneficiaries? What we also would like to look at is if we can find some input on the investment strategies, if we can find comparable IOPs and insurance companies, can we get any conclusions there on who's got the better protection? So for now, maybe more questions than answers, but this is the work and we've been doing on this area for now. And with this, I'll give the word to Karel, and we'll take questions after Karel's session. So Karel? Yep.
Okay. Thank you, Martin. Thank you. Also, my greetings to everyone in the meeting here. Thank you for participating to the meeting. And yes, indeed, we have decided to conduct a survey on what are actuaries doing in the risk management of IRBs in the first place. Of course, our focus is not only on IRB at this pensions risk management, but talking about pensions first, focus is on the institutions for occupational retirement pensions. That is what an IRB is. And why did we decide to do this? Well, we have the example of a survey that has been organized for insurance companies, and this in the context of Solvency II. The survey dated from 2018, not 218. And we observed that for insurance companies, all actuarial function holders are actuaries, that about 50% of the risk management function holders for insurance companies in Europe are actuaries. That together with Solvency II, also our professional framework has been maturing, has received more maturity, because we have as well European actual standards as European actual notes that have been created in the context of risk management and Solvency II for actuaries. And also in the meantime, the SERA, those Certified Enterprise Risk Actuaries, have been created and has been a success in this area. Now, the question was, do we see a similar evolution in the context of IRBs and influenced by what we call IRB 2? We conducted a survey for this, and we had 12 answers from member states that are in the EU at this moment. You know, as Martin has shown to us that about 21 member states do have IRBs. We also had an answer from the UK and Switzerland, which is important because these are countries where pensions and actuaries and pensions are quite important. Now, we have to be careful, of course, this is only an intermediary report and is based on not complete data. So we also wanted to see how we can add value to our actuaries, to our members, and learn from all of the countries. Let's see what the results are, Martin. So first of all, in the field of actuaries as function holders, we observed that also for the IRBs, about 50% of the IRBs have an actuary as the risk management function holder, although this is very heterogeneously spread over the countries, because Ireland is a country where there are a lot, by far the most of IRBs that are existing, and where you can see that actuaries are indeed most of the time the risk management function holders. While there are other countries where there are less Arabs as such, and you can see what is the representation of our actuaries as risk management function holders. In addition, we also can say that for all Arabs, actuaries are the actuarial function holders. So if we have succeeded to put the actuaries on the scene from a legal point of view, as well in insurance as in pensions, Solvency II and IRB II actual function has been introduced and indeed is filled in by the actuaries as such. The risk management function less, and we have to be careful here. As I said, in some cases, in some countries, you see that the risk management function and the actual function are combined. It's a bit in the image also of the insurance companies, be it the smaller insurance companies. You could say that in most of the cases, an IRB is rather small compared to insurance companies. If they are not the risk management function holder, often it is referred to the asset managers. And this is quite a surprise. And you could also wonder whether the DB, defined benefit, defined contribution, characteristics of the plans and of the Arabs could not be a reason why there is such a difference. Indeed, the requirements for defined contribution pension funds are not the same as for defined benefit systems. So we could conclude that probably as far as the function, the actual function holder and the preparing how we take care of this actual function, this is more the pensions committee that will be in charge of it. On the other hand, if we want indeed to represent the actuaries when we are talking about how to organize the risk management function, it's probably a task for the risk management committee. But to do so, we probably have to have a more understanding of what is happening really in this context. So what can we then do? The next, Martin. It can be interesting also to see that the IRB legislation, the directive has been implemented in all countries. That seems obvious, but is not exactly the case. There are differences with European legislation in a number of countries. We have to be aware that UK and Switzerland have their own specific legislation when it is about pensions, and certainly also when it is about legal or prescribed roles for actuaries. The supervisors have been publishing guidelines for actual function and risk management function, but as you can see, certainly not in all of the member states. But what is important, that is that it is not only an actual function or a risk management function, but often in also European countries and certainly in the UK and in Switzerland, actuaries have a legal role already from the start in their own legislation and do play a role in this. And this will probably have an impact on why these results are so different. Okay, well, what can we then learn from this? What are our observations and what are our conclusions? Well, we can see that actuaries are not necessarily the risk managers of pensions institutions. Only 6 on 12. And we can say that it is not, although DCDB could be a reason, but this 85% of the Arabs are indeed managing DB plans. So it is also for DBs that the actuaries are not present. But why could this be? Is this because pensions actuaries are not interested in risk management, where we try indeed to expand our activity to more to risk management, or are the actuaries interested in the risk management of pensions? But if they are not, then you could wonder who is modeling cash flows and is evaluating the risk positions. If they are not, who is helping Arabs to decide on the risk appetite, the risk tolerance, and the corresponding limits? If they are not, who is then executing the asset liability management and modeling for these institutions? And if they are not, who is taking then care of the ERM aspects of the risk management systems that have to be applied and implemented within the IRBs? This is a question, and we were asking ourselves, and we will have to try to answer this. We'll come back on this a little bit later on. Of course, when we see that other professions are involved in risk management, it is, of course, an opportunity for us as actuarial organizations to seek for contact with, for example, asset managers or others that are representing these professions. Okay. Now, what probably is playing quite an important role in all these observations is that, and that is not new, of course, that pension and the environment for pensions is very different all over Europe, and this in contradiction with insurance. The insurance activity is much more homogeneously organized in Europe, although there are differences in products and in sizes and all these things. But the essence of insurance is more or less the same, which is not the case for pensions. Pensions are different environments in different countries, as well from a legal point of view as from a private point of view. The way that the Social Security is organized, the way that occupational pensions are organized, the way that these are built, funded, and so on, all these things are quite different. And as we have been seeing on the statistics from Martin, also the IRBs, so the institutions for occupational retirement provisions, they are very different from country to country. The number is very different, the size of them is different, and the nature is also different. So this makes it, of course, very difficult to make comparisons and to try to see what we can do exactly. So as the scene, the environment is different, it is not a surprise to say that the approach of risk management for the IRBs is also different, and that is, by consequence, the actuary is playing a different role in this. Now, actuaries, as I have already said, are indeed not the risk managers. I already asked you the question whether this is a lack of interest or whether this is because of the environment. And we have, of course, to create a better understanding and awareness so that we can try to come with a common ground, as well what the actual approach and the professional framework could include. So then I can really conclude with some other questions, Martin. What Martin already has said is that Solvency II is indeed a protection of the policyholders of the insurance company from the point of view of the commitment, the liability of the insurance company as such, and not necessarily of the occupational pension that is underlying it. And so companies, employers are paying premiums to insurance companies to fund their pension scheme, and the insurance company is offering products to make it possible to cover these pension plans, but they are not responsible for the governance or the management of the pension scheme as such, the relationship between employer and employee. There, where IRB 2 is indeed covering the governance and the risks of the institution, and together of the pension scheme as such. Now, we can see that in some countries, there is a role for actuaries at the level of the pension scheme that is not necessarily linked to the IRB nor to the insurance company, but there is thus the concept of the scheme actuary. And this is probably something which is a concept that could link, that could indeed bring together the pension risk management independently from how it is built and how it is funded. And probably we could ask ourselves whether this is the way forward, and that the actuarial associations could advocate, could present this as a good way, as the good way to come to a decent risk management for pensions all over Europe. So that we can then combine Solvency II and IRB II. We can indeed make sure that all interests of stakeholders, as well the institution, the employer, the employees, the beneficiaries, are respected, and we can then make that we can monitor the fairness of the underlying products that are offered by, as well, insurance companies as by the IRBs. So we are not completely understanding what is exactly happening within the IRBs, and we will try to come to a better understanding by profiling the countries and by making sure that concepts are understood, and probably that we can find a common denominator in all these concepts, so that we can try to come to a possible best solution for risk management in pensions and what actuaries can do for this. I think we can come to the next poll. Yes, we have here a question and I think that the question we will ask you will be less complex than the one we can see here. But we could ask you a question whether you think we can indeed, as actuaries, the AAE, in this case, the European Association of Actuaries, it is the Actuarial Association of Europe, of course, makes it sense that we create a framework so that risk management for pensions can be implemented in different environments, and that we continue to work on this. I invite you to answer the yes or the no question in this case. Leave it up to Caroline to see when we have a result we can present. Okay, I have the impression that we have a big majority that support us and that would like us to continue our efforts. Of course, there are people that think we should not invest our time in this, but I think that the majority is overwhelming and that we can be encouraged to continue our work. Thank you very much. And I suppose there are some questions, Martin.
Well, thank you very much to both you, Carol, and Martin for a really interesting talk. It looks like you have an additional agenda to follow going forward. So thank you very much in advance for all that you will do in that space too. We've got, again, please can I ask if you want to ask any questions, put them into the Q&A. There is one question that's come through from an anonymous participant. In slide 10, I think you referred, this is in Martin's presentation, to assessment of mechanics protecting retirement benefits. And I guess if the person wants chapter and verse, then probably there are EO papers that describe some of these mechanics. But do you have any kind of like broad examples or kind of a summary of what these things look like in practice to help answer this question?
The short answer is no, and it's a very good question, and it's something that we're also trying to follow up on, and we actually just started a new sub-working group where we're trying to exchange knowledge from the different countries on subjects like this actually. You could say that it will also differ if you're an IOP with a defined benefit scheme, where the assessment of the mechanics protecting those there will more be protecting the IOP being funded. Whereas if you have the defined contribution schemes with or without guarantees, your risk assessments there would be what you have put in place to protect the pension plans there. But the short answer is also that it's not very clear how you should do these risk assessments. So it will be up to the actual function or the actual function holder or the risk management function holder to figure out how to do these risk assessments. So that is also something that we want to take a deeper look into. Should there be more guidance on these topics, or should it be up to the individual IOP how to do it? But we're trying to gather some insights and knowledge on this area as well.
Brilliant. Sounds great. We'll look forward to it. Maybe I can just pose a question for Carol. Looking at your statistics, it seems like if you wanted a career in this kind of space, the place to go to would be Ireland. Do you have any views or thoughts as to why the Irish are so keen on having actuaries as risk management function holders? Is there something that we can leverage elsewhere, or is the solution to my career using to use your freedom of movement and just head off to Dublin or somewhere nearby?
Well, of course, this question you should ask it to Richard, I suppose. But I can answer you for Belgium, where there is 60% as you have been. And I think this has to do with the fact that actuaries are indeed the profession that is helping out IRPs. And there is no other way that actuaries are helping the pension schemes. When you look at the insurance companies, there is an actual function of an insurance company is not at all examining the funded status of the underlying pension schemes. It's only examining the solvency of the insurance company offering the products to fund them. And here you see that indeed the actuaries are in the seat of risk management function, because no one else is looking after the risk management as such of the institution and of the pension scheme. Well, for example, if you look at the UK, and there you're better placed than I am, Malcolm, when you look at Switzerland, when you look at other countries, I was talking to a Canadian, this is not Europe, there exists a role. There is a pension actuary. There is indeed someone taking care as an actuary of the pension scheme as such. And I think this is the explanation. I suppose it is not the case in Ireland.
Okay, thank you. I can't see any other question in the Q&A. So maybe I would just offer one final question, perhaps to both of you. You talk about the pensions landscape varying a lot between different member states. Do you think that will change over time? Do you think it'll become more harmonized? Or do you think if we did the same thing in 20 or 30 years' time, we'd still have a very heterogeneous mix of practices?
Good question. Carel, will you start?
I'm always ready to answer something, and that gives you the opportunity to think about it, which is probably much better than immediately answer the question. But well, this is that's a political question as such. That is probably not about actuaries, but about political choices in Europe. Is Europe harmonizing social security, tax situations, social legislation, and so on? It's not for immediate, clearly. I even have the impression that there is a tendency to to stop harmonization as such in these fields. Now, that's my own not a preference, but observation, let's say it in this way. So I don't see immediate coming together on social security and so on. The public finance situation in Europe is also so different between countries. There is even not one currency in all of the currency. You know that the euro is only in a number of countries. So it's very difficult. I'm a little bit afraid that the pension scene will be quite heterogeneous also in the future.
Yes, I agree. I think also we have in some countries we see that the IOPS is typically in runoff, so you will see less and less IOPS there and more and more insurance companies. But as Krill said, I think also it kind of depends on the political system and what tax legislation you have in the different countries that will make sure what is most relevant for the companies to create an IOP or an insurance company.
Okay, well, thank you very much indeed for those answers. I can't see any further questions either on your presentation or presentations or on the earlier presentations. If there are any further questions, do please feel free to put them into the Q&A. But maybe if that isn't the case, it's almost 3 o'clock European time, 2 o'clock Irish and UK time. So it's time to call this webinar to a close. Can I thank all the presenters, to Martin, Carol, Frank and Jason, for some really good presentations, for all the insights you provided and for answering the many different questions that were posed. Can I also thank Carolyn Lutzeller for masterminding and organizing the kind of the structure of the webinar. So thank you very much, Carolyn, for that. Can I thank all the participants for joining us, making this a successful webinar, and particularly for the participants who asked some very insightful and probing questions, which the presenters were very well qualified to answer. So thank you very much, and on that I will close the webinar.